US diesel just topped $5 a gallon. Regular gas is nearing $4. Brent's sitting around $81 after Iran declared the Strait of Hormuz shut. Washington answered with a blockade on Iranian ports. The oil market is now, in ADOLA's own words, subject to rumors. By the end, you'll know the one currency most impacted by this shock and how traders are actually thinking about playing it. For traders, the pump price is just the symptom. The real story is how energy inflation reshapes rate expectations and capital flows. Roughly a fifth of global crude passes through Hormuz. When passage is threatened, net energy exporters win first. The Canadian dollar, Norwegian krone, and Mexican peso tend to firm as oil rallies. But the mechanism isn't identical. CAD tracks WTI closely, so USD CAD often falls on supply fear. NOK adds a European gas premium, making EUR-NOK cleaner. On the losing side, Japan and the Eurozone import nearly all their oil. Higher crude widens deficits and drains real income. The yen is especially exposed. Dollar oil invoicing forces yen selling to pay for barrels, feeding USD JPY intervention risk. And the currency everyone's watching? Hold that thought. The payoff is coming. The dollar wears two hats. It's the safe haven in Middle East escalation, and now a major energy exporter cushioning the blow. So USD, JPY, and USD CHF diverge. The franc competes for haven flows, keeping USD CHF pinned while USD JPY runs. Diesel is universal. Everything reaches the shelf by truck. So this oil spike is a broad inflation impulse, not one gas number. A supply-side shock is stagflationary. Prices rise, growth slows. The Fed leans hawkish, the ECB leans dovish under the same shock. That divergence is the EUR-USD downside engine. Meanwhile, the Bank of Japan stays boxed in, unable to defend the yen. But watch the caveats. A spokesman said the market moves on whim. Trump floated a 20% Hormuz fee Monday, then dropped it. De-escalation can gap oil lower and unwind CAD and NOK longs violently. Stops matter more than conviction here. Stick around, the actionable setup lands next, and it's worth the wait. The single currency to watch? The Japanese yen. Long USD JPY captures both the oil import drain and the rate divergence at once. The play trader's eye, long Petro-currencies against the yen, USD JPY topside, but respecting Tokyo's intervention ceiling. The caveat stays, a demand destruction shock could rally dollar and yen, breaking the thesis. Size for the surprise. This is a bet on persistent supply fear driven by erratic rhetoric. In a market ruled by whim, the survivor is the one size for surprise. Read the full analysis on edgeforex.com. Link is in the description.